What if I told you there's a proven way to buy a dollar for 50 cents? And no, this isn't some get-rich-quick fantasy. It's the single most important principle that has guided the world's greatest investor, Warren Buffett, for over 60 years. While most people are gambling on stock prices glued to their screens, riding these waves of hype and fear, a small group of investors are quietly and consistently buying wonderful businesses for way less than they're actually worth. They don't have a crystal ball. They aren't getting illegal inside tips. They're using a simple, powerful philosophy that absolutely anyone can learn. In this video, I'm going to show you exactly how they do it. I'm going to break down the mental framework that separates the world's most successful investors from everyone else. This is the secret to sound investing, and by the end of this video, it'll be yours. Let's be honest, most people who put money in the stock market aren't really investing. They're speculating, they're gambling. They buy a stock because the price is going up, and they're just hoping to sell it to someone else for a higher price before it all comes crashing down. Their entire focus is on the price, that little number flickering on a screen, being pushed around by daily news, emotions, and herd mentality. That is a game you cannot win consistently. The true investor, though, they're playing a completely different sport. They are guided by a simple phrase, made famous by Warren Buffett's mentor, Benjamin Graham. Price is what you pay, value is what you get. That one little sentence is the foundation of a multi-trillion-dollar empire and the key to this whole concept. While the gambler is obsessed with the flickering price, the investor is obsessed with the underlying value. They don't see a stock ticker, they see a piece of a real business. Their goal is to figure out what that business is actually worth, and then patiently wait for the chance to buy it at a serious discount. This all boils down to two pillars that let you buy that dollar for 50 cents. First, you have to figure out a company's intrinsic value, and second, you must demand a margin of safety. So what on earth is intrinsic value? Put simply, it's the true worth of a business. Imagine you wanted to buy a local coffee shop down the street. You wouldn't just glance at its daily sales, you'd dig in. You'd look at its profits, its debts, its reputation, and most importantly, how much cash you could expect to pull out of that business for years to come. That is exactly how a value investor looks at a huge company like Apple or Coca-Cola. The textbook definition is that intrinsic value is the discounted value of all the cash that can be taken out of a business during its remaining life. It's basically an estimate of all the future profits added up and then translated into today's dollars. Now you're probably thinking, whoa, that sounds crazy complicated. How can I possibly predict all the future profits of a global corporation? And you're right, it's not about finding one single magic number. Even Warren Buffett says it's better to be approximately right than precisely wrong. The goal isn't perfection, it's to be rational and conservative. The key is to focus on businesses that are easy to understand, with a history of consistent earnings and a strong competitive advantage, what Buffett famously calls an economic moat. Think of companies with bulletproof brands, powerful network effects, or cost advantages that rivals just can't touch. A company like Coca-Cola has a brand that's a landmark in almost every country on earth. That brand is a massive part of its intrinsic value. Once you have a conservative estimate of what the company is worth per share, let's just say $100, you have your anchor. You now know what that dollar is truly worth. The next step is where the real money is made. This might be the most important concept in all of investing, the margin of safety. Warren Buffett's legendary partner Charlie Munger explained it perfectly. He said to think of investing like you're building a bridge. If you know that 10,000-pound trucks are going to drive over your bridge, you build it to handle 30,000-pound trucks. That extra capacity, that 20,000-pound buffer, is your margin of safety. It's your protection against the unexpected, against storms, bad luck, and even your own mistakes. In investing, your margin of safety is the discount between what a business is worth and the price you actually pay. It's a simple rule. You only buy something when the market is offering it to you for significantly less than your estimate of its intrinsic value. Why is this so critical? Because you will be wrong. Your valuation will never be perfect. The economy can take a surprise turn. A new competitor might pop up. The company's management could make a dumb decision. The margin of safety is your cushion that protects you from all of it. It's what keeps you from losing money. As Buffett famously says, rule number 1, never lose money. Rule number 2, never forget rule number 1. The margin of safety is how you follow that rule.
So, let's see how this works with some simple math. The formula is beautiful. Margin of safety equals 1 minus, open parenthesis, market price divided by intrinsic value, close parenthesis. Let's go back to our company that we've conservatively valued at $100 per share. Now comes the hard part. We wait. We don't buy it at $100. We don't even buy it at $90. We wait for the market to do something irrational, and it always does. This is where Benjamin Graham's famous story of Mr. Market comes in.
Graham asks you to imagine you have a business partner, Mr. Market, who is a complete emotional wreck. Some days he's euphoric, offering to buy your shares for way more than they're worth. On other days, he's a depressed, panicked mess and offers to sell you his shares for absurdly low prices. Your job is to ignore his drama and take advantage of his insanity. When he's in a full-blown panic and offers to sell you shares in our $100 value company for just $70, you finally act. Let's plug that into our formula. Margin of safety equals 1 minus, open parentheses, $70 divided by $100, close parentheses, equals 0.3 or 30%. That 30% is your bridge's extra capacity. It means even if you're wrong about the value by a bit, you're still protected. It's how you buy a dollar's worth of business for just 70 cents. And if you're patient enough, you can wait for him to offer it to you for 60 or even 50 cents. If a light bulb is starting to go off and you're seeing how this simple framework can totally rewire your approach to investing, do me a quick favor and hit that subscribe button. We break down powerful ideas like this every week to help you become a smarter investor. This isn't just a fun theory. This is the exact strategy that built Berkshire Hathaway into a fortress. Just look at Buffett's investment in Coca-Cola in 1988. After the 1987 market crash, everyone was terrified, but Buffett looked past the short-term fear. He saw a business with one of the most dominant brands in the world, predictable profits, and tons of room to grow. He calculated its intrinsic value to be far higher than its stock price, so he invested over $1 billion, locking in a huge margin of safety. That one investment has since ballooned to be worth over $25 billion, and it pays him hundreds of millions in dividends every single year. Or think about See's Candies. In 1972, Buffett and Munger bought this boring little chocolate company for $25 million. They knew its fiercely loyal customers gave it the power to raise prices year after year, creating a predictable gusher of cash that made it worth far more than the price tag. That $25 million investment has since generated over $2 billion in earnings for Berkshire. In both cases, they didn't predict the future, they simply understood a great business, waited for the market to panic and give them an attractive price, and let their margin of safety do the rest. The last piece of the puzzle isn't found on a spreadsheet. It's all about your mindset. As Charlie Munger said, the big money is not in the buying and the selling, but in the waiting. Value investing requires a temperament that is the complete opposite of our fast-paced, instant gratification world. It requires patience. Insane amounts of patience. You need the discipline to do absolutely nothing for long periods, just waiting for the perfect opportunity. As Buffett explains, investing is like baseball, but with one huge advantage: it's a no-called strike game. You can stand at the plate and watch thousands of pitches fly by overvalued companies, speculative fads, businesses you don't understand, and it costs you nothing. You just wait for that one perfect, slow, fat pitch right down the middle, and then you swing for the fences. That fat pitch is a great company you understand, trading at a price that gives you a massive margin of safety. This mindset is what separates the foolish gambler from the patient investor, and the long-term results aren't even close. So, how do you buy a dollar for 50 cents? You stop thinking like a gambler and you start thinking like a business owner. You stop staring at the price and start focusing on the value. First, you find a wonderful, understandable business and do the work to estimate its conservative intrinsic value. You figure out what that dollar is actually worth. Second, you learn to see the manic Mr. Market as your servant, not your master. You wait with unwavering patience for his moments of fear to offer you that business at a price so low it gives you a huge margin of safety. That is your 50-cent price tag. This philosophy isn't about being a genius. It's about being rational, disciplined, and patient. It's a framework for managing risk and taking the fear out of investing. This is the proven path to building lasting wealth, and now you know exactly how it's done. If you want to see exactly how to calculate intrinsic value, make sure you watch this next video, where I walk through a simple valuation model, step by step. And don't forget to subscribe and hit that notification bell, so you never miss a lesson on your journey to becoming a true investor.